Risk tolerance assessment and asset allocation. Risk tolerance assessment and asset allocation are two important concepts in the world of investing. Understanding your risk tolerance and properly allocating your assets can help you make informed decisions and achieve your financial goals. Risk tolerance assessment is the process of determining how much risk you are willing to take in your investments. This is a personal decision and can vary from person to person. Factors that may influence your risk tolerance include your age, financial goals, time horizon, and investment knowledge. It is important to be honest with yourself during this assessment, as taking on too much risk or too little risk can have negative consequences. Once you have determined your risk tolerance, the next step is asset allocation. Asset allocation is the process of dividing your investments among different asset classes, such as stocks, bonds, and cash. The goal of asset allocation is to create a portfolio that balances risk and return based on your risk tolerance and financial goals. A common strategy for asset allocation is to diversify your investments. Risk tolerance assessment. Questionnaire. Many financial advisors and online investment platforms offer risk tolerance questionnaires to help investors assess their risk tolerance. These questionnaires typically ask about factors such as investment goals, time horizon, financial situation, investment knowledge, and comfort level with volatility. Psychological factors. Consider psychological factors such as emotional response to market fluctuations, ability to sleep at night despite market volatility. Understanding your emotional reaction to risk is crucial in determining your risk tolerance. Experience. Consider your investment experience and knowledge of financial markets. Experienced investors may have a higher tolerance for risk and be comfortable with more aggressive investment strategies. Risk profiles. Conservative investors. Conservative investors prioritize capital preservation and are willing to accept lower returns in exchange for reduced risk. They may prefer a higher allocation to fixed income securities and cash equivalents, with a smaller allocation to equities and alternative investments. Moderate investors. Moderate investors seek a balance between risk and return. They may have a diversified portfolio with a mix of equities, bonds, and alternative investments to achieve moderate growth while managing risk. Aggressive investors. Aggressive investors have a higher tolerance for risk and are willing to accept greater volatility in pursuit of higher returns. They may have a larger allocation to equities and alternative investments, with a smaller allocation to fixed income securities. Asset allocation. Equities. Equities historically offer higher long-term returns but also come with greater volatility. The allocation to equities should reflect the investor's risk tolerance and investment objectives. Conservative investors may have a lower allocation to equities, while aggressive investors may have a higher allocation. Bonds. Bonds provide income and stability to a portfolio. The allocation to bonds depends on the investor's risk tolerance and income needs. Conservative investors may have a higher allocation to bonds, while aggressive investors may have a lower allocation. Alternative investments. Alternative investments such as real estate, commodities, and hedge funds can provide diversification and potentially enhance returns. The allocation to alternative investments should be based on the investor's risk tolerance and investment goals. Cash equivalents. Cash equivalents provide liquidity and stability to a portfolio. The allocation to cash equivalents depends on the investor's liquidity needs and risk tolerance. Regular review and rebalancing. Regularly review your investment portfolio to ensure it remains aligned with your risk tolerance and investment goals. Rebalance your portfolio as needed to maintain your desired asset allocation and risk profile. As investors age or their financial circumstances change, their risk tolerance may also change. It's essential to periodically reassess your risk tolerance and adjust your asset allocation accordingly.